Hey everyone, welcome back to the Weekend Charts. Charlie Bilello here. Thanks for joining me. We have a big show for you today, a lot to discuss. I want to start out by talking about November, and it was definitely a November to remember in terms of markets, stocks, and bonds. Huge returns across the board. I want to start with the S&P 500 here. Here's a table showing you the 20 biggest monthly gains for the S&P 500 going back to 1950. And November here, 8.9%. That was good for 18th place on this list. And as you can see here, I put some stats here showing what the market tends to do going forward. Most of the time, the fact that the market is up big in a particular month definitely doesn't seem to be a bearish indicator. We're actually seeing above average returns going forward if we're looking at the past when we've had these big returns in the past. So that doesn't mean that we're going to see the same today, but certainly can't say that just because you've had a big month, the market isn't going to be higher a year from now. Oftentimes it is, and oftentimes actually the gains over the next year are even better than the average of all months. So if we're looking at the stock market, obviously a huge gain there. That wasn't the only thing that was moving. We also had the bond market and just a sharp move down in yields driving this. And so the two obviously have been very correlated in terms of the stock market and the bond market moving together over the past few years. Very high correlation. We saw that again this month, but really the move lower in the 10-year yield was what got people excited in terms of the stock market, and the bond market, of course, responded as well. So we had that 10-year yield moving down over 50 basis points on the month, and we had that period in October there where it got briefly above 5%, the 10-year yield. It closed out the month at 4.37%, so very sizable move lower, and that lifted the bond market up to a 4.5% gain. That was the best month for the U.S. bond market since May 1985. So you don't usually see this type of return on the upside or downside for the bond market. Obviously, last year we were seeing extremes in terms of negative returns, and this month, best month since 1985. Where does it rank historically? We have data for the Bloomberg Aggregate Bond Index going back to 1976, and this was the eighth biggest monthly return for the U.S. bond market. And as you can see here, similar to big gains in the stock market, certainly did not seem to be a bearish indicator in the past. Here as well, you seem to have usually market positive a year later and above average returns going forward. So stock market, big month, bond market, big month. You put the two together, and what do you get? Well, a pretty good month for the 60/40 portfolio, which of course everyone was just saying was dead, and it came alive in a big way in November. 7.3% return for that US 60/40 portfolio. And if you go back to 1976, this was the ninth best month. So only month in the past 30 years that was higher in terms of the 60/40 portfolio than November was April 2020. So after that COVID crash, we had a big snapback. But other than that, this was the second best month here for the 60/40 portfolio over the last 30 years. So kind of stunning there. And it wasn't just U.S. stocks and U.S. bonds. Really, it was a rising tide in November that lifted pretty much all boats. And if we look at the year-to-date numbers in terms of different asset classes, you could see now mostly in the green. And a month ago didn't look like this, but just after those huge returns, we now have bonds up on the year. We now have REITs up on the year after a big return in November. We now have small caps. Remember, they were lagging. Well, they came back in a big way in November, and just pretty much every asset class rising. And in terms of the year on whole, it's still that same theme where it's kind of the reverse of last year, where we're seeing Bitcoin, NASDAQ 100, and growth stocks outperform. But we're starting to see that rally brought it out in November, and it remains to be seen what will happen going forward. But what we're seeing so far, at least in the first trading day of December, is seeing a real broadening in terms of small caps up big, at least for the first day. So that will be the big question heading into 2024, is what we saw this year going to start to broaden out, where we start to see international emerging markets, and small caps kind of catch up here in terms of investment performance. So let's talk about sentiment. 180-degree shift in sentiment over the past month. And what's driving that? Of course, it's price and the fact that prices have gone up in a vertical fashion. Well, investors very quickly have changed their mind in terms of they were very bearish just 4 weeks ago, and now not so much. So if we look at the AAII, this is a poll of individual investors that they do each and every week. Over the last 4 weeks, the percentage of bears in that poll went from above 50%, which was definitely on the higher end, not super extreme, but definitely on the higher end looking historically, went from above 50%, the percentage of bears, all the way down to less than 20%. And this is pretty rare to see the percentage of bears this low. We haven't actually seen it this low. You have to go all the way back to January 2018, which followed a huge market advance in 2017, where the S&P 500 was actually up every single month that year. So we have fewest percentage of bears since then, and we have the S&P 500, of course, 9% higher. So once again, we see this situation where investors are more bearish when prices are down and they go lower, and they're less bearish when prices are higher. It's kind of a crazy thing. We just had Black Friday and Cyber Monday, and of course, if you were shopping for things, you wanted to see things on sale. You wanted to see prices lower, and you probably took advantage of a lot of discounts on those days. Well, investors behave in the opposite fashion to that. When they see prices rise and rise rapidly, they get more excited, more bullish, and the opposite occurs when they see prices fall. So that's the sentiment picture. But this shift from just 4 weeks ago is kind of very rare to see this quick. You don't usually see sentiment shift from kind of a negative bearish level to over bullish here on the bullish side in such a rapid fashion. So here I'm pulling data looking at the percentage of bulls minus the percentage of bears, so the spread between the two. And just 4 weeks ago, bears outnumber bulls in this poll by 26%. And if we fast forward to today, bulls outnumber bears by 29%. So that shift, that 55% shift in terms of moving from net bearish sentiment to net bullish sentiment, that's something that you very rarely see. We actually haven't seen a 4 week shift that big since March and April of 2009. And if you remember what was happening then, the market bottomed in March 2009. And of course, it rallied in a vertical fashion. And so investors went from extreme bearishness to much less so to net bullishness back then. They're doing the same today. And so what's going to happen with sentiment from here? Well, it depends what the stock market does from here. Sentiment is always dictated in terms of price, but this is just something very extreme. And investors were caught, as we talked about a few weeks ago. The pain trade was higher. Investors were caught with too much negativity heading into November. And a lot of that negativity is now gone after this huge month for the market. So in terms of all-time highs, the S&P 500 and NASDAQ 100, we talked about this last week, still less than 2% away, almost there in terms of total return all-time highs. But the Dow actually ended November at a new all-time high in terms of total return. You include dividends. So the bear market from last year has been erased. If we look at the last 10 years for the Dow, it's like we didn't have these bear markets. It's pretty much been a solid ride. If we're just looking at the 10-year period, 181% in total. That's a 10.9% annualized return for the Dow looking out over the past 10 years. And obviously, the S&P 500, NASDAQ 100 have done even better than the Dow. And breaking down the components this year, what do we find? Where's the leadership? Well, definitely reflecting the growth and technology story. Top 4 names in the Dow this year, all in the technology space. We have Salesforce, Intel, Microsoft, Apple. So the reversal from what we saw in 2022, where tech underperformed, tech outperforming by a very wide margin this year. And what's lagging? healthcare, energy, industrials. These are the names that haven't really been participating this year. And again, coming back to that question, are we going to see a reversal again in 2024 where these other sectors start to participate? 2023 thus far, really a story driven by technology and the biggest names in the indices. So let's talk about the recession that never came here. This was the biggest surprise, obviously, for markets because I polled people at the end of 2022, and most people, the vast majority of people, were in agreement with economists who were saying there was going to be a recession in 2023, and we just haven't seen it. We got updated GDP data for the third quarter, and it was actually revised higher. So 5.2% annualized growth in the third quarter moved up from 4.9%. And if we look at year over year, 3% increase in GDP year over year. So very much obviously in the past year, not in a recession. And the US expansion now, 41 months in duration, and the annualized real GDP over this period of time, 5%. Okay, so that's the third quarter. No recession. No one's expecting a recession in the fourth quarter when we get the data, but are we going to see another 5% quarter for GDP? Not likely. If we look at the Atlanta Fed, who is very close in terms of their third quarter expectation, very close to the actual number, they're looking for somewhere between 1 and 2%. And we also have Wall Street, the consensus estimate between 1 and 2% as well. So this idea that now all of a sudden we're going to have 5% GDP growth, not likely. Looking at 1 to 2% for the fourth quarter. We'll see how this shakes out in the next couple of weeks. We're going to get a lot more data, and these estimates will change. But even at 1 to 2%, that's obviously still not in recessionary territory. And that's been the big surprise or shock for markets that caught a lot of people off guard from where their expectations were entering the year. So let's talk about housing. The deep freeze here, you've heard this from me before, but we have to just continue with this theme because nothing has changed there. If we look at the recent data in terms of pending home sales, lowest since April 2020. So very little activity going on in the housing market. April 2020, economy is pretty much shut down in the US. No one's going out and shopping for homes. And we have the lowest activity in the housing market since then. And this has been the kind of crazy picture that we've seen this year is the divergence between home prices, which have come back and hit new all-time highs over the past few months, hit another new all-time high again in September. This is Case-Shiller data. The divergence between that and affordability. So price is extremely high, but we have using U.S. housing affordability index near record lows. And that's just a divergence that obviously shouldn't be able to continue for too long. Like something has to give. Either affordability becomes better in terms of mortgage rates coming down or incomes going up, or we have to see housing prices go down or at least stabilize and go nowhere. And it looked like in 2022, we were going to see affordability improve by prices going down. And then this year, the huge shock in the housing market was the inventory collapse. So just absolutely no supply. And that actually lifted prices for the few remaining people who were able to afford houses. Well, there was such a little amount of supply on the market that prices actually were higher than a year ago and hitting record highs. And if we look at the 20 city index here is actually up 4% year over year. Most cities now positive on a 1 year basis. Again, in 2022, it looked like most cities were negative and looked like they were heading more negative, but that kind of reversed course. We have a number of cities hitting all-time highs in September. And the question here is for the housing market, are we going to see affordability improve through mortgage rates going down or prices going down? But I think at the very least, however we get there, what we saw in terms of the last 3 years or 5 years in terms of the housing market appreciation, people should not be expecting that to continue. These are just unbelievable appreciation numbers that you don't see outside of a housing bubble. We only saw this really one other period of time in the U.S. housing market, looking back in history, and that was the period in the early to mid 2000s in terms of home prices just surging higher. And we saw that again over the past few years. So If we look at this affordability picture, this is why the housing market is really frozen. You don't have that demand because affordability is so low. And this is basically telling you that the percentage that you would need of your income, 44.7%, the percentage that you would need to buy that median priced home based on your income in the US has never been higher. And it's actually well above where it was at the peak of the last housing bubble. So hopefully, this will reverse course in 2024 and come down. One way it could start to move lower if we see a meaningful move lower in terms of mortgage rates. And over the past 4 weeks, following that move lower in the 10-year Treasury yield that we showed earlier, we're seeing a pretty sizable decline in terms of mortgage rates. From a peak here of 7.79%, we're now down to 7.22% in a very quick period of time. We have mortgage rates now down, I think, 5 straight weeks. So for home purchasers, this is one part of the equation. I think even if mortgage rates were to come down to, let's say, 6%, it's still going to be a stretch for a lot of people. You really need that price side to come down as well, because a 40% increase over a 3 year period, like we saw, is just way, way ahead of people's incomes. And we're not likely going back to 3% mortgage rates anytime soon. So we'll see what happens for the housing market. But for the month of December, not likely to change. As a seasonally slow period. So we're likely to see that frozen housing market continue for at least through the winter here. So the rental market, very different story. And this is the good news for people who haven't bought a home yet, first time home buyers looking for homes. The comparison in terms of rents versus home prices, much more affordable to rent. And that's because rents are not continuing to hit new all-time highs here. They've actually gone sideways now for about a year and a half. Over the last 4 months, rents have actually come down in price. You tend to see seasonal weakness in terms of this period in the average year, but we're seeing even bigger weakness this year. So yes, we had a huge advance in terms of rent increases, and that was very difficult for people because obviously their incomes didn't go up this much. But over the last year and a half, incomes have continued to go up. If we look at the average hourly wage, and rents are actually lower than where they were a year and a half ago. So that's very good news. If we look at the year-over-year rate of change for these monthly rents, this is now showing another year-over-year decline of around 1%. So whereas home prices about 4% higher than a year ago, we have rents lower than a year ago, and actually lower than a year and a half ago. And all signs are kind of pointing to this continuing for at least a few more months. If we look at the vacancy rate in terms of rents, it's up to 6.4%. That's above average. And the expectation is then rents will decline likely again in December. So good news for renters. Now, when is this going to be reflected in terms of CPI? Well, it's already started, but I think you're going to see an acceleration here. Now, we know that CPI acts with a huge lag in terms of shelter CPI, has been moving down, but it's nowhere near obviously being negative or flat. It still showed a 6.7% increase year over year in the last CPI report. I think over the next few months, this is going to come down sharply, and it's likely to really have a big influence on overall and core CPI. So the good inflation news that we got for the month prior, we're likely to see it again in November, and this is going to be the big driver of it. And shelter CPI, that lagging indicator, is going to start to catch up with these lower rents. Now, here's the big chart in terms of should you buy, should you rent? Well, we talked about this a month ago, but really this equation has gotten even more probably exacerbated because home prices continue to go up and rents are actually falling here. So if you're a first-time home buyer and it's 52% more expensive for you to buy than to rent, and you only plan to live in a house for a few years, probably makes sense to rent now more so than ever before. And this equation will change. We could see over the last the last cycle during the peak of the housing bubble, it was very much more expensive to buy than to rent, and that changed and moved in the other direction. So all of this is cyclical. But for now, if you're in the market looking for a home, either mortgage rates have to come down, wait till your income goes up, but stretching in terms of buying a home when it's going to cost 50% of your income to buy that home, that's probably not a good idea for most people. So let's talk about the Fed and now huge shift in the market in terms of the past few weeks in terms of expectations, where a few weeks ago the market was saying maybe in June or July the Fed would cut rates, and now they're actually saying a rate cut is coming in March. And what's driving that? Well, big part of that has just been the inflation story, and every single data point that we seem to get is coming in better than expectations, which means a lower than expected inflation rate. And we just got this latest data on the PCE price index. This is something that the Fed looks at very closely. It actually moved down to 3%. I think the expectation was 3.1%. So that's the lowest we've seen since March 2021. It peaked in June 2022 at over 7%. So sizable move lower. It's actually now lower than its historical average, which is 3.3%. And if we look at core PCE, which the Fed always says is their preferred measure of inflation, that moved down to under 3.5%, which is the lowest since April 2021. So very interesting that if you go back to April 2021 and you look at what the Fed was talking about, they were not talking about hiking interest rates at all. Interest rates were still at zero. So they were very comfortable with the idea back then that inflation was going to be transitory. What they were seeing wasn't going to last. Very different attitude from the Fed, it seems, today. And what we now have is a spread between the Fed funds rate and this core PC inflation rate of about 1.8%. So that means the Fed is at their tightest level of monetary policy since 2007. And really the question that market participants are asking here is how long they're going to keep the pause going before they cut. And if market expectations are correct, not much longer. It's only going to be a few more months, talking about a rate cut in March. And this is the shift here in terms of probability, 65% probability now of a rate cut in March. If we look even a week ago, it was much lower, but a month ago, maybe there was a 10% chance of a rate cut in March. Now we're at 65%. Now, these expectations jump around a lot, as as we know, so any data point can really change this dramatically. But this is a pretty big shift here that we've seen in a very short period of time. And not only is the Fed expected to cut earlier in terms of they're going to cut in March versus June or July, which is what the market was expecting a few months ago, but now the market's saying the Fed's going to be more aggressive in cutting those rates, and they're going to bring them all the way down to 3.5% by the end of 2025. Now, that's looking out way too far. Again, all of this will change. But what is the Fed saying about all of this chatter about rate cuts and an easier monetary policy? Well, Powell once again came out this week and said the talks of cutting rates are premature and more hikes could happen. So he really doesn't want the market to get ahead of itself here. He wants these tighter monetary policy conditions to continue to do their job, which is to help try to bring down that inflation rate. And if people start thinking ahead that the Fed is going to cut rates, well, that's going to then make their job more difficult. So I think this doesn't mean the Fed won't cut rates in March, but they're not yet ready to signal that they're going to do that. They'll likely wait to a meeting before they're ready to cut, before they really signal that to the market. For now, I think they're very comfortable saying we're going to stay higher for longer. We're going to do what it takes to bring inflation down, because core PCE is still at 3.5%. So if it doesn't get down to their 2% target, and let's say it just stops at 3% or wherever and starts moving up again, and the Fed had cut rates thinking that it was going to continue to go down, well, then they're in a bad place. So I think they need, as Powell has said, more evidence before they're going to start signaling a rate cut. But the market is saying regardless of what Powell's suggesting, the Fed is going to be much easier in 2024. And of course, that's probably part of the reason why the market has rallied so much in November is that expectation that the Fed is going to be much easier going forward. So, in terms of the money supply, very clearly the Fed has gotten the message here. This has been a huge factor, in my view, in terms of driving inflation to the upside and definitely on the downside as well with this normalization in terms of the money supply. If we look at M2 here, it's now been down 11 consecutive months on a year over year basis, down 3.3%. No, that doesn't erase all of the money that was created during this crazy period of money printing. But again, if we could just hold the line here, normalize for a few years, let the economy, economic growth, wages catch up to this, well, then perhaps that would be a much better situation than continuing. And that's what I've argued. A lot of people push back on that, said you can't do that. It's going to cause a depression. So far, no depression. And so far, over the last 2 years, the money supply has shrunk 1.9%, largest in history. And if we look at financial markets, we look at the S&P 500, it's flat now, basically, over the last 2 years. So, yeah, we did have a bear market, intervening bear market. But overall, so far, market's been very resilient and I think responding positively as they should in terms of this better inflation outlook. So tackling inflation was way more important than anything else. So I think the Fed has gotten that right. They continue to get that right. So regardless of the people pushing them to cut rates, that this is going to cause too many problems by being where they are, I think the Fed has to stick to their guns and see this through and make sure those inflation expectations really come down and stay down. So I want to end, as I always do, with a positive thing, and that would be the day of travel that we had over the Thanksgiving holiday weekend, where it was the busiest day of travel according to the TSA in history. So finally, we can put this to bed in terms of recovering from that COVID crash in travel, where a lot of people said we're never getting back to normal. We're never coming back to where we were before. Well, thankfully, those predictions, those doomsday predictions, weren't true. It only took a few years, 2 years too long in my view, but we finally were back, and this is great news for a lot of people, obviously, who haven't been able to see their family in years. A record level of travel this year. So hopefully that continues each and every year going forward. So with that, we'll end it right there. Have a great weekend, everyone. Thanks for joining me on the Weekend Charts, and I'll see you next time.